We are here today to talk about 1031 exchanges. And so I will pass it over to our guest expert here, Scott Saunders. Scott, thank you for joining us today.
You bet, Jonathan. Great to be with everybody. And just heads up, we had some little issues getting on camera. I'm not sure why, but I plan to, in a fairly short period of time, give everybody everything you need to know about the basics of 1031 exchanges. I've already looked at some of the questions. Yes, we'll talk about reverse. We'll talk about partial exchanges, and we'll get into the funds. Maybe you're talking about the security of the funds. So super excited to do this. I really want to give you everything you need to know. So I saw a few of you have done 1031s. A few of you have not, so you'll know the basics. Here's my quick disclaimer. Everybody's got a different tax situation. Run it by your tax and legal advisors, right? So I'm just giving general information. Be sure to pull in your CPA. Now, from the very onset, I just want to simplify it. If you look at a taxable sale, that's when an investor transfers a property up and they get back cash. An exchange is really at the most simple level. I've got a property used in a business or held for investment. I give it up and I receive back other property, what we call like-kind properties. Taxable sale, property for cash. 1031 exchange is property for other property. That's all it is. And so I just want to kind of simplify what it is. We'll get into the mechanics, the time deadlines, and some of the rules, but this is a really powerful strategy. So I want to start off here. I guess the first polling question, and Jonathan, I don't know if you launch it on your end as well there. Um, Only real property held for investment or used in a business qualifies for a 1031 exchange. So pop in and kind of answer that. And then as you're answering it, I want to kind of flesh out what that is. So one of the key concepts you'll see right there is real property. That's real estate. What's interesting is up until January 1st of 2018, it was possible to do exchanges on real estate and also personal property. Things like heavy equipment, rental cars, construction equipment, tractors, aircraft used in business, etc. Today, after some changes in the tax laws with the Tax Cuts and Jobs Act, only real property qualifies, or what we call real estate. So that's all that really qualifies for an exchange today. But you're going to see just how broad real estate is. We're going to unpack that a little bit later, and you're going to see it encompasses a lot of different types of property. So I understand many people with TurboTenant, have a few single family rentals. I'm a 1031 exchange expert. I've also got a few rentals too. So I'm in your shoes, and we're going to, at the very end, just kind of look through what does an exchange scenario look like in real life. So 1031s for everybody. They have been in the tax code since 1921, well over 100 years. They help any investor. They allow you to defer paying all capital gain taxes that would otherwise be due if you sold it in a taxable sale. And to kind of simplify it, 1031 exchanges are the way you build wealth with real estate. If you've got one rental property with a good equity position, you can exchange out of one and go into maybe two replacements. A few years down the road, the equity might build up and you can exchange from those two into four properties. And maybe you go from four into six or eight. But this is the way that a real estate investor builds wealth with real estate. Instead of selling and having to pay all the taxes, you just redeploy the equity into more like-kind property. And what happens is the taxes are deferred, and we'll get into that in a moment, but they're deferred into the future. And here's the beauty of a 1031 exchange. As long as you keep doing subsequent exchanges, you can do this over and over and over again. And you can pass on highly appreciated property to your heirs. They get it with what is called a full step up in basis. In English, that just means they get it worth, the basis is worth the fair market value at the time somebody passes away. So I've been doing this since 1988. I'm a senior vice president with asset preservation, and we've structured hundreds of thousands of exchanges. So we've seen everything that's out there. And this is really the way that people in real estate build wealth, build a big portfolio. Compare it with stocks. If I have Apple or Amazon stock and I bought it low and I sell it high, I've got to pay taxes on the gain. With an exchange, real estate investors have a huge advantage because Section 1031 allows us to reinvest that capital and redeploy it and defer paying those taxes and doing it over and over. So the person that is exchanging is going to build a real estate portfolio much faster than somebody who sells and pays the taxes. Now, let's switch over to the dreaded topic of taxes because you'll see we get asked a lot. Well, what is the capital gain tax? And it's a little bit more nuanced than that when we're dealing with investment real estate. There are actually four different taxes that could be owed. So the first one is a tax on depreciation recapture. If you own a single family home, you typically depreciate it straight line over 27 and a half years. If you sold it in a taxable sale, all of that depreciation that you took advantage of each and every year on your tax return, you'd have to pay it back with that depreciation recapture at a 25% tax rate. So that's higher than the capital gain rate. The remaining federal gain is taxed at either 15 or 20%, depending upon your tax bracket. And there's something called the net investment income tax. So this is a new tax put into the code in 2010. And for single filers that have what we call net investment income, that includes capital gain over $200,000, they'll have to pay this additional 3.8% tax. Married couples filing jointly start to pay it over 250,000. And let me hit the last one there. State taxes are a big issue. If you're fortunate and you live in a state with no tax, Florida, Texas, Wyoming, a handful of states, this isn't an issue. If you live in California, the maximum state tax rate is 14.4% now. So you've got to add all of these taxes together. And I can tell you from doing hundreds of thousands of these, at the end of the day, people are surprised how much they would owe in taxes if they've held property for a while. It's a pretty significant tax hit. So Section 1031 of the code allows you to defer paying those taxes. And speaking of the code, we'll switch over to it. Here's what it says. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. In the very first line there, it says no gain or loss should be recognized. This is what we call in kind of tax speak non-recognition treatment. Sometimes you might hear people refer to these as a tax-free exchange. It's not really accurate. It's a tax deferred exchange. So the gain that you have in one property gets rolled into the replacement property that you acquire. So it's deferral. It's not tax-free. You're deferring it. But as I mentioned earlier, you can do this for your entire life and do it over and over and over again. And that's a strategy for most of you on this call. You own real estate or you want to own real estate. There's really, if you're going to go buy more real estate, you're always going to be in a better position doing a 1031 exchange. Now, there are a few things you can't exchange, and I'm just going to cover two of these bullet points. Stock and trade or other property held primarily for sale. So if the intent is to hold it for sale, not long-term investment, not rental income, that is excluded. You cannot do a 1031 exchange on that. So if you do a fix and flip, for example, right, you get an asset, you fix it up and you sell it for a profit, that intent is holding it for sale, not long-term investment. That won't work. People that do, home builders and people that build homes and things like that, those are being held for sale. They don't qualify. If you build for new development and you just build it and sell it, again, that won't qualify. So it's got to be held for investment. And we're going to get into that in a few slides down the road of, how long does it have to be? What does that look like? I just want to draw your attention to the fourth bullet point here. An interest in a partnership does not qualify. So you can't exchange out of a partnership interest. You can't exchange into a partnership interest. So they're precluded. What you've got to go into is real property. When you own a partnership interest or an LLC member interest, they're the same thing. You really own an interest in an entity that owns real estate. So many of you might hold title in LLCs and partnerships, and as long as your entire LLC or partnership exchanges, there's not an issue. There are some more advanced planning strategies. more than I can get into in this shorter presentation where we can handle partnership situations, but I just want you to be aware of it. You can't do an exchange out of or into a partnership interest. So, George, does a 1031 exchange apply to a condominium? The answer is yes. Any real estate, if it's real property held for investment, will qualify. So I can exchange out of a condominium, a single family, a vacation home if it's held for investment, and I'll touch upon that. Commercial, retail. So if it's real estate, it qualifies as like-kind property. So hopefully that helps you there. By the way, I've kind of got the chat window open. So just as you're going along, my whole objective in talking with Jonathan is to make sure you get your specific questions answered, right? And you kind of know the process. So feel free to ask questions and kind of go along on that. Now, we do exchanges for a lot of reasons. Obviously, tax deferral is the biggest one, right? Taking all that equity and redeploying it. But you can use this to leverage, get more of the bank's money. If you've got a property free and clear, you may want to take on some financing to boost your return on investment, your ROI. So adding leverage. Certainly, if you go in land, you might want to exchange out of land into single family. That's another way. In fact, the example I'm going to share at the very end is that exact scenario, going out of bare land into single family. So here's a question from Ramon. Can you use a 1031 exchange on an owner occupant sale to purchase a multi-family? So when you say owner occupant, if it's your residence and you live in the property as your home, it won't qualify. That will not qualify. It's got to be held for investment, not your primary. But Ramon, let's just take an example. What if I own a triplex and you live in one unit and rent out two of the others? You can certainly do an exchange on the two units that are rented out. And today, you guys, there are so many opportunities here. People do Airbnb, right? You got a home, maybe you've got I'm here in Colorado, we've got a lot of basements. People have walkout, lock-off basements where they rent out under their house a little studio. Even that portion qualifies. So there are a lot of applications, Airbnb or a rental unit, or maybe you've got a mother-in-law, a little studio over a detached garage. All those things qualify. So anything that's rented qualifies. Now, Barbara's got a question. Can I exchange a 4-unit to a 4-unit and live in it? You can do an exchange fourplex to fourplex, right? But the portion that you live in won't qualify on that, Barbara. So that square footage would probably be an easy way to do that. Whatever portion you're going to live in won't qualify. So let me just kind of make up some numbers. If I sell a $300,000 fourplex and I buy one for $500,000 and I'm going to live in one unit, you might be able to do an exchange because the units that you're going into have covered your 1031 exchange. And we'll kind of get into those requirements a little later. So on this screen, you guys, I just wanted to share, there are a lot of things you can do, right? You can go for cash flow. You can diversify into different geographies. You can diversify into asset class. You can consolidate. You can do all sorts of things. So Brad's got a question. Can a sale of a property in an LLC be used to purchase another property already owned that is in another LLC to pay off debt? Good question, Brad. You've got to go into new properties. So short answer is no. You can't take exchange funds from a sale and apply them to pay down debt. You've got to go into another like-kind property. And Brad, let me give you the rationale. The whole purpose of an exchange is that we're really just redeploying into another asset, right? We're taking money in one property and we're just going into another property. It's called the continuity of investment. Our capital just goes into another property. We're never actually receiving the cash ourselves. It just goes from one property to the next. So that can't be done. Now, I'll keep moving along here answering questions, but I'm going to go to the next slide. Let me just give you one principle to keep in mind. You want to look at how you own the property that's being sold in an exchange. And we want to make sure the same tax owner sells one property and then purchases the replacement property. And I use the word tax owner because I can sell as in my name, Scott Saunders, and I can buy in a Scott Saunders single member LLC because it's what's called a disregarded entity. Everything flows to me. So you want to look at the entity, but if you're in one entity, you want to make sure that entity buys it. And then you'll see there, I do kind of mention husband and wife issues. It's not uncommon in today's world where people get remarried and they've got separate assets. If the wife has held an investment property for investment, she needs to do an exchange into the new property. She doesn't want to necessarily bring her husband into the purchase at that time because she has held it for investment, not her husband. So you kind of want to unpack that in situations where maybe there's divorce and separate assets, but just general principle, how you're selling is the same way you want to purchase. And you really want to look at kind of the tax ownership of that is the way you do it. Now let's get into the fun one, because this is kind of what was already being asked. These are examples of like-kind property. So I want you to see how broad, right? It could be a ranch. That looks like a ranch in Texas somewhere, in New Mexico. You can exchange for a vineyard, a single family, retail, industrial, office. A lot of things qualify. So the next slide here probably says it even better. What doesn't qualify in an exchange? Well, first off, you cannot do an exchange on your primary residence because it's not held for investment. And then you cannot do an exchange on property that's held for sale. Now, let me switch over to a few questions coming in. Victor had a good one. Can I use a 1031 for another country? So, Victor, I'm going to answer that two ways. You can only exchange U.S. property for other U.S. property. It's got to be anywhere within the United States qualifies. It also includes Guam, the Mariana Islands, and the U.S. Virgin Islands, but only for U.S. property. Now, you cannot do an exchange out of the U.S. into another country, and you cannot exchange out of another country into the U.S. You can do something which is a foreign for foreign exchange. So I can exchange a condo held for Mexico and for investment in Mexico for another property in Mexico. So foreign for foreign is all that works in that regard. Otherwise, that it's just got to be within the United States. So excellent question. So Brad's got a detailed one here. And Jonathan, is it all right that I'm taking these questions as we go? Is that all right for you?
Absolutely. You're doing a great job. Yeah.
All right, cool. I just wanted to double check. Brad says, if you sell two properties with two different LLCs, how does the new purchase work? So, Brad, I'm going to answer a question with a question. I know that's bad form, but it depends. I need to know what those LLCs look like. If they're both what we call a disregarded LLC, where Brad Moxley is the disregarded member, you're the tax owner of both of them. And so you could combine on a purchase. If the LLCs have multiple members and then it's taxed as what we call a partnership or what's known as a regarded entity, then each one of those needs to do its own exchange separately. So the short answer, Brad, is I need to know more about the types of LLCs and how it is. And that's something that your CPA can get involved with and help you on. A tax advisor is great. A good qualified intermediary can provide some guidance too. So excellent questions coming in, by the way. Love them. So keep them coming. Let me go back to like-kind property. Any real property held for investment or used in a business can be exchanged for any other. Now look at the third bullet point. Raw land, commercial property, single-family rentals, a multifamily, office, industrial property. Now look at some of these other ones. An easement. Jonathan's, in Denver, I believe, and we did an easement exchange up in Boulder, an $8 million conservation easement. You could do conservation easements, agricultural easement. You could do something called a perpetual communication easement, a cell tower. Air can be exchanged if it's what's known as an air right or a transferable development right. And I won't get into the details. In some states like Colorado and some of the Western states that are very arid, where water's precious, water rights are considered real property. You can exchange those. Now look at the next one. A vacation home, if it's held for investment, qualifies. So that can also qualify. If it's got to have rental income. So here's the easy way to remember this one, and I've got that revenue procedure, but I'm going to give you the cheat sheet on it. All you have to do is hold a property for 2 years, rent it for 2 weeks in each year, and keep your personal use under 2 weeks. So think of it as, I call it the rule of twos. 2 years of ownership, 2 weeks minimum rental usage, no more than 2 weeks of personal usage. And there's a final category there called fractional ownership. You may have heard of these tenant in common TICs, or they're referred to as Delaware Statutory Trust or DST. So bottom line, very broad. I know most of you are doing single family, but I just want to let you know it does provide a pathway to do things. Now, this next one here, The question we get asked a whole lot, and I want to spend a few moments, is how long do you have to hold a property before it's held for investment? And there is no holding period. It all comes down to your intent to hold for investment. So the IRS is going to look for objective, provable facts that either bolster and support the intent to hold for investment or contradict it. So time is important, but I just want everybody to be aware there's not a specific holding period. There's not 1 year, there's not 1 year and a day, not 2 years. It really comes down to your intent. And ideally for everybody on this webinar, since you're getting knowledge, in a perfect world, it would be great if you could support that investment intent and you have facts that support that investment intent. So I just want to point that out because sometimes there's some misinformation on that topic. Emily's got a question. What if a property was originally used for personal occupancy and is now a rental? Great question, Emily. So I move out of a residence and I rent it out. That's now an investment property. And Emily, you've just kind of pulled back the curtain on a great strategy. If you've lived there 2 out of 5 years, you qualify for what is known as Section 121 tax exclusion. Now it's a rental, so you could sell it. Let me just make up a simple example. Emily, let's just assume you're married. You've lived there for 2 out of 5 years, and let's say there's $1 million of gain. You put $500,000 in your pocket under 121 exclusion, then you go do an exchange and do other like-kind properties. So that's a great strategy to convert equity that was in a home into rental income. Marcella Bates, can you use it for property outside the US? So I just want to make sure everybody's clear. US property has to be exchanged for anywhere in the United States for other US property. You can't exchange from the US to a foreign country, but you can do a foreign property for a foreign property exchange. So let me kind of get in to what you need to do for deferral, because this was a question that came up. So if you want 100% deferral, you need to reinvest all of the net proceeds. So let me explain that. Net means after closing costs, after the real estate commission, the title company's fees, recording fees. It's net. It's the money left over after you pay off the mortgage and pay all the closing costs. If you want to have some money taken out, you can obviously do that. Somebody asked at the beginning about a partial. So if you take money out, it's called cash boot, and you just pay taxes on that amount. The second rule is you want to acquire property with the same or a greater amount of debt. So you look at your mortgage payoff, and if you want full tax deferral, you want to have the same amount of mortgage on what you're going into, and you can obviously add more debt. You can leverage up. So reinvest net proceeds, acquire property of same or greater debt. And on the debt, if you go down in mortgage, it's called mortgage boot, and you just pay taxes on that. So let me walk through two examples here to kind of illustrate it. And I think when you see it, you'll realize it's really simple. So somebody's selling a property for 900 grand. Their mortgage payoff is 300,000, closing cost 60,000, leaving net equity of 540. They're going to buy for 1.2 million. So they're going to increase their debt from 300,000 to 660. They reinvest all of their net equity, and they have no mortgage boot, no cash boot. So this is 100% tax deferral. Now, on the next slide, I'm going to show you a partially deferred exchange. And for the question that was asked earlier, a lot of people do partially deferred exchanges. About 1/3 of all of our customers do a partially deferred. So don't think you always have to have 100% deferral. Sometimes people pull money out, they'll go buy an RV or do whatever they want, right? Buy a nice sports car, whatever it is. You don't have to do a fully deferred. To AC's question, what about properties that have no mortgage? Great question. Then I just need to reinvest all of my net equity. Then I don't have to worry about the mortgage. So that's pretty easy on that one. Let me show you some boot. So here's the same sale, but now I'm going down in value. So my debt goes from 300,000 to 260. There's $40,000 of mortgage boot. I take 100,000, I put it in my pocket. So I go from 540 to 440. I'm going to add the mortgage boot plus the cash boot. There's $140,000 of what we call boot. Now, you want to run that by your tax advisor. You might have some other factors that can mitigate the tax consequences. So that's generally taxable to the extent that you have a capital gain tax consequence. But Again, talk to your tax advisor. If you have things called suspended carry forward losses, you might be able to offset that. So that's, again, why it's really important you involve your tax advisor in every exchange. At least a quick phone call, review what you're doing. It's just the smart way to go. Now, there are a whole bunch of different ways to do exchanges. I saw a question about reverse, and I'll get into that after we cover the basics. So the third one down is the most common exchange. Probably 97, 98% of all exchanges are delayed exchanges with a qualified intermediary. So we got a polling question. In a delayed exchange, an investor has 60 days to identify a replacement property. True or false on that? So I'll just kind of sit tight for a moment, and then we're going to really unpack this a little bit. So you'll know the answer to this. And all right, I'm seeing it. Good. It's interesting to see the feedback coming in. I want to make sure by the time we wrap up this webinar, you've got this one down. So I'm glad to see that there's a variety of opinions.
Yeah,
Let me go
this one's
ahead.
pretty neck and neck right now.
It's what?
It's pretty neck and neck right now between true and false.
It is. No, 48 to 50. I'd say it's split. That's 48 to 52. All right. Well, you guys, let me go on to the next slide here, and we're going to look at this one. I'm going to solve it for you. This is the delayed exchange. So the answer to the question is that you don't have 60 days, you only have 45 days to do this. So you got a limited time frame to do this. I'm going to walk you through the delayed exchange. This is the most common one. So taxpayer is you, that's the real estate investor. Here's the process. You list your property for sale. Once your property is under contract with a buyer, we then set up the 1031 exchange. The qualified intermediary is going to step into your shoes as the seller, and that's done through an assignment of your purchase and sale agreement, your contract. It's assigned to the qualified intermediary. So you contact a qualified intermediary, and by the way, you'll hear them called qualified intermediaries, intermediary, QI, facilitator, accommodator. It's that middle man, that middle company that holds the money and prepares all the documents. So I just want to let you know there are different terminology, but it's all the same role. Now, the property is sold to the buyer, and the buyer, this is what's key, gives the money to the qualified intermediary. The qualified intermediary is the seller. So this is what we call day zero of a 1031 exchange. Then you have 45 calendar days to identify property. And the next slide, I'll go into more detail. So you identify something, you get it under contract. Now the qualified intermediary takes their money they're holding, they buy the replacement property and have that deeded back to you, the real estate investor. So nowhere do you as an investor sell or buy. The qualified intermediary steps in and they sell it. And the qualified intermediary holds your money and they buy the replacement property. You're just giving up title to the property you're selling and the one that you're buying. Now, the total exchange period is a maximum of 180 calendar days. So it's 45 days to identify, plus 135 days to close on what's been identified. And if you've got questions there, I'm going to go ahead and kind of go through this. So let me get through a few slides to kind of get into some details. So the first one is the 45 days ends at midnight of the 45th day. So that's your 45-day identification period. Maximum of 180 or the date you've got to file your tax return. That's your maximum period of time. So now we're talking about words like identify, and you're probably like, well, what does that actually mean? Ramon, great question. Can I use a delay to acquire new land and then build on it? Ramon, short answer is yes. That's called an improvement exchange or a build to suit. You've only got a maximum of 180 days to do that. So you do have some time constraints, and I'll cover that in a little bit. But short answer to your question, yes, you can. So these are the big time requirements, and they're pretty easy. You know, if you work in advance, they're pretty easy to hit. Now we've got to identify property within some specific rules. Using the 3 property rule, you can identify 3 properties of any fair market value. So identify one at 200,000, one at 400, one at $1 million. The value doesn't matter, but I'm limited to only 3 properties here. So that's the 3 property rule. Another rule allows you to identify more than 3, but no more than twice the value of what you sold. So if I sold for $1 million, I can identify as many smaller parcels, but not over 2 million, because that's twice. So those are the two primary rules, 3 property rule and the 200% rule. There's the 95% exception. It's rarely used. It just says you identify more than 3 and over 200%. You then have to close on at least 95% of what you've identified. So in English, you've got to pick. Am I going to use the 3 property rule? Am I going to use the 200% rule? Or am I going to use the 95% rule? And one little caveat, you can substitute in the 45 days. So if I identify on day 3, A, B, and C, but you find a better property with your real estate professional on day 40, I revoke A, B, and C, and I substitute with D, E, and F. Whatever you've identified on midnight of the 45th day, that's what you have to buy. There's no wiggle room. There's no exception after midnight of the 45th day to identify anything else. So there's that month and a half time period where you've got to be very specific of what you're identifying, and that's all that'll qualify in the exchange. Now, the question we get asked a lot is, well, what does it mean to identify? And I think many of you are going to probably wonder, do I have to be under contract? The answer is no, you don't have to have a contract. I could drive down my street and identify any 3 homes. Now, I'm not sure that's a wise thing to do, because maybe the sellers don't want to sell and maybe we can't agree on price. So you don't have to be under contract. I'm going to recommend you're probably negotiating with that seller and you feel like you're going to be able to come to terms. Here's what you have to do. You have to identify in writing, and this one's a key word. You must unambiguously describe the property. So a street address or legal description got to be done by midnight of the 45th day, and generally that goes to the qualified intermediary. So let me kind of recap, because the delayed exchange is what most of you are going to be doing. Probably those of you that did exchanges did delayed. At the beginning, consult with a good qualified intermediary and your tax advisor. Make sure the contract is an assignable contract. Now you've got to make sure the exchange agreement and all the documents are signed before closing. Identify property in 45 days, and then you've got an additional 135 for a maximum of 180 days. I'm not going to hit all these things of what not to do. Just know you got to be sure that you follow the rules. And the very last one in Dobruck, somebody backdated their identification notice, and they were whacked with literally millions of dollars of penalties. So just follow the rules. The exchange is such a powerful tool to grow a portfolio. So, and you're working with TurboTenant, you've got all the resources to scale, right? If you're at 3 assets, you can go up to 4, 5, 6 and keep going up. So it's something to look at. And I would say this, I'm a real estate investor. Sometimes you want to look at your ROE, your return on equity. You might have a lot of equity in there that's maybe not giving you the best return. Yeah, it's cash flows, but your cash may not be working very hard for you. So keep that in mind. This is just an example, and I'm going to go through these quickly. I'm kind of watching time here a little bit. This is selling several properties. I'm going to sell 3 properties. The money all goes to the intermediary. I'm going to buy 1 larger property, maybe a commercial. Just be aware you've got to get all those sales done within the same 45 and 180 days if it's 1 exchange. The next slide is going to show you the more common variation. This is when I sell 1 property and then I take it, the money goes to qualified intermediary. Now I'm going to buy 3 replacement properties. So I'm going to leverage up, right? I'm going to grow my portfolio. So this scenario is probably the more common one that we see out there, is multiple that. Now, somebody asked about a reverse. Great strategy. This is when you need to buy the new property, the replacement property, before you sell the old. So you actually have to close on it. You got to close on the replacement property first, then you have 180 days to sell your existing one. This is great for a very tight market where inventory is limited, or maybe an off-market deal, something like that. The improvement exchange is where we're going to build new on land, or maybe we're going to improve and refurbish an existing property. Now, a reverse improvement, I'm going to buy the land first, start improving my structure, and then sell my existing property. A lot of owner users take advantage of that structure. And then a last one is something called as a leasehold improvement. And this is a little more complex strategy where we literally make improvements to property that was already owned. Now, it's a little more nuanced than that. I'm simplifying it. You can't go into property you directly own. We create a new 30-year leasehold interest and then put improvements on that. But these are all called parking arrangements, and I wanted you at least to be aware that all of these are available. And I got a question. Can you sell a condo and you use a delayed exchange to acquire land? So the answer is yes. Any property held for investment can be exchanged for any other. I can go improved to unimproved, unimproved to improved, residential to commercial, commercial to residential, as long as you hold it for investment. Now, when you sell a condo, which maybe has depreciation on it, and I go into land which can't be depreciated, there might be a tax consequence here. There might be some depreciation recapture. So the short answer is yes, I can do that, but you want to talk with your tax advisor. So it's like-kind property. And I want to stop. I've been going fast here. Let me just open it up, whether you want to do it on the chat or come on mic or whatever. Any questions at this point? I know I've been going kind of fast, but any questions anybody want to ask right now?
Yeah, Scott, I wasn't sure if you saw we got one Q&A from Phyllis saying, can a trust do a 1031 if they buy a like-kind property?
Oh, I missed that. Yeah, absolutely, Phyllis. Any entity can do an exchange and go into a new property. So a trust can, revocable or irrevocable. An LLC can, an S corp, a C corp, an individual. So any entity, if it's the entity doing the exchange, where things get a little tricky is where you've got something like a partnership or LLC where people may want to go their separate ways, and that's where things can get a little tricky on that. Let's see, I've got a question about a transcript. I believe the recording of this and everybody has access to these slides. Absolutely. From Luke, flip properties. Oh, moved up here. Let me get back up there. Okay, record that. How soon do you need to start collecting income on exchange? If you're doing an investment property, you need to start holding it for investment right away. So if you're, a reasonable amount, your intent is to hold it for investment. So you want to have at least, available for lease, get it leased up. You can't say, oh, nobody's renting my property for, a year. You've got to list it at fair market and make a reasonable attempt to do it. So that's kind of the answer. I know where people go with that. What if I ask rent that's way above market and nobody leases it? That's not going to work. Now, Luke, flip properties don't qualify. What if they're held for a rental a certain period before? I love that question, Luke, before selling. Again, the intent must be to hold for investment, right? So you're not flipping it. So I can do a fix and flip on an asset, then I get a tenant in for a year or two, and then I can do an exchange. So you got to look at how is it being treated most recently? Was it rented or was it being held for sale? That's the key issue. And Luke, again, you got to pull in your CPA. Some of these things are a little bit of a gray area, and you want to get guidance from your CPA. Some of it depends on how risky or aggressive they are and how you are as well. So there are a lot of fact patterns there that you really got to break down to your individual. Emily asked, who is a qualified intermediary? Great question, Emily. So it's a middle company. A lot of real estate professionals can recommend them. A lot of times your closers can. There's a group called the Federation of Exchange Accommodators. Their website's 1031.org. So they're the middleman. And I'm going to go through at the very end what to look for. Joe Jennings has a question. I buy a home for $85K. I sell it for $250. Can I pull out the 85 without tax consequences? No, Joe. Any money you pull out is called taxable boot. So any money you pull out, you can't recoup your original investment. I'm going to jump back into the presentation. We got a polling question. A 1031 exchange must be set up before closing on the sale of the relinquished property. Super easy there, true or false? Let's just kind of see. All right, we got a balance of answers. Always interesting to see. There you go. All right. I'm glad. Yeah, I love these polls because it gives me some data. So let me answer this question for you. 100%, you absolutely must set up an exchange before you close. If you close on it, it's too late. You can't do an exchange after the fact. You got to set it up before closing. Now, I want to walk through, and I'm going to do this quickly here. I'm going to show you how powerful an exchange is. And this happens to be one I did many years ago, and I'm going to walk through it really quickly. But I want to show you where I started with, which is a piece of land, and then I want to show you where I finished. And I think this will kind of help unpack um, how you do an exchange. To Ramon, with an improvement exchange, you've got to have the improvements done in 180 days. Real property improved, not just getting the money out to the builder. So you have essentially 6 months is your maximum time period there, Ramon. So just want to clarify that. Okay, purchase land for about 90 grand, goes up in value to 300,000, and then the downturn hits. The land had negative cash flow. It wasn't appreciated anymore, and about 6 grand in taxes. So I did an exchange, selling one piece of land and exchange into 5 new construction properties, 3 of them in Clarksville, Tennessee, 2 in Wichita, Kansas. And I'm going to show you that I just did a kind of a copy and paste right out of Zillow so you can kind of see them. So that's the land, piece of dirt. First property, kind of just a basic home, 3 bedroom, 3 bath, another 3-2. And then I bought 3 properties that were side by side in Clarksville, Tennessee. Now, here's what I want to show you. So that's just, I want to just give you kind of bring it to life. Here's what I came out of. Came out of land worth 265. The value today of those assets, roughly 1.4, give or take. So I'm up more than $1 million. Gross rental income, much, much higher than having a piece of land, 8,000 a month. And then the annual, looking at about 96 grand annual gross rental income. So you can see I really improved my position just in one exchange. And what I want to share and have you think about is if everybody here looked at your assets, you might want to do just 1 or 2 exchanges in your lifetime. And it could significantly enhance your portfolio. And I guarantee you, TurboTenant will love to work with you all the way along the way there. As you grow your portfolio, they've got the capability to bring in more and more assets. So whether you're going from 2 to 4 or 4 to 8 or 8 to 16, you can do it all there. I'm going to answer a few more questions that are coming in. Luke, I was told as long as you notated on the home sales contract in writing, seller intends to do an exchange of the proceeds. An exchange did not need to be set up prior. Luke, unfortunately, that's what we call misinformation. Here's why, and I'll give you the explanation, Luke. If you receive the money, it's a taxable sale. If the money sits at the title company or escrow company, it's a taxable sale. You either have an exchange set up and the money has to go to the qualified intermediary when it closes. If you have access to it in any way, it's called constructive receipt. It's taxable. So I'm sorry, Luke, that's probably why this is good, for everybody. Sometimes there's a little bit of information out there that's a little fuzzy or not accurate. So keep that in mind. I'm going to kind of wrap up and then I'll open up for questions at the very end. There was a question about intermediaries. So the number one thing you want to look at is doing your due diligence on the company that's holding your money. Here's the scoop. The qualified intermediary industry is not regulated at the federal level. So Jonathan's in Colorado and so am I. There's a handful of states that have state level consumer protection laws. Colorado, Nevada, California, Oregon, Washington, Virginia. I'm missing one. Anyway, there are a few of them. But selecting the qualified intermediary is the most important thing. Who can do the 1031? Let me go into that question. It cannot be your realtor. So it can't be anybody that's your agent. Your realtor or your real estate professional is your agent. They have an agency relationship. If your CPA or attorney can't do it, if they've given tax or legal advice in a 2-year period. So let me do this. Let me get through the next couple slides, and then I'm going to kind of open it up to questions at the end. So do your due diligence, things you want to find out. Does the qualified intermediary offer customers the backing of a large creditworthy entity? There are qualified intermediaries that are subsidiaries of banks. They're qualified intermediaries. They're subsidiaries of big title insurance companies. So we're a subsidiary of Stewart Title, a big title company, been in business for 120 plus years. You want to look at the financial rating. What's the balance sheet? And then this one's really important. Does the qualified intermediary do due diligence on where they're putting the money? You don't necessarily want to be a big depositor in a little local community bank. You want to work with top tier financial institutions. Now, I'm going to give you on the next slide the most important thing when you're looking at intermediary. Does the qualified intermediary offer a segregated account? You want segregated and separate accounts for your funds. You don't want them commingled in one big pool. You want to have your funds go to the qualified intermediary and held in a separate account for you, or if you're a real estate agent, for your client. You can certainly held in qualified escrow trust accounts. You can look at the fidelity bond coverage, but you want them to stay held in a separate account. That's critical. Now, I'm going to go back and start going through. I see a few questions I missed here. I'm going to start unpacking these a little bit. And Luke, hopefully, hopefully that was clear on what's there. Luke, if I intend to set up an exchange and intend to take boot to buy a new speedboat, does the intermediary accept all the money and then issue the funds? Great question, Luke. No, you just should tell your closing officer you want to receive X amount. I think boats cost a lot these days. Let's say it's $100,000 boat. That's a really nice speedboat, Luke. You tell the closer, give me 100,000 out of the closing directly. Have the rest of it go to the qualified intermediary. Now, alternatively, you can have everything go to the QI, and then you can wait and see what you buy, and maybe there's money left over. So you could take it out up front. You could also take it out after the exchange is over, or you could take out a little up front and a little at the end. So you've got some flexibility, Luke. It's your money. It's just any money you take out is taxable boot. So you can have as much or little taxable boot as you want. So great question there. Um, can you talk about the potential tax implications? You do an exchange for the original property, the new investment property appreciates and is sold down the road. No 1031. Great question. You're going to pay taxes then on the gain with the first property and the gain with the second. So if you've got capital gain and you don't do an exchange, then you have to pay all four taxes that I discussed earlier. All four of those are owed. So that just is what we call a taxable sale. And a lot of people do that. You might decide later on you want to get out of real estate and maybe it's time to take money off the table. No big deal. You can certainly do that. It's your choice to do a taxable sale, a 1031 exchange, or a partial exchange. George asked, 1031 fund, you can only go into real property. It's got to be real estate. There are a couple of mechanisms out there, things known as Delaware Statutory Trust. And I don't have time to go into the complexities, but they're owned by a sponsor. They're for accredited investors. And you can get into commercial property where somebody else manages it. But you're not going into a fund. You're going into a DST interest. That's what that is. Is there a requirement to have a full transaction happen in one calendar year? No. Great question, Barbara. You just have 180 days. That's all you have there to do things, is you've got 180 days maximum. And you guys, at the very end here, if you've got questions, and I'm sure you do, my contact information is there personally. You've got my email and my phone number. And then our company, Asset Preservation, we've got headquarters in California. We've got a New York office and website and email. We spend all day long answering questions, and we welcome any questions you have in that regard. So let me do this. Let me kind of go back to the chat. I haven't looked at the question area. I'm just looking at the chat here. If you've got questions on anything I've discussed, we're down to the last 5-6 minutes or so. Fire away. I want you to get a lot of value out of this.
Yeah, and I just dropped a pretty big message there in the chat. Sorry for taking it over with this, but got a few links for everyone. If you're not signed up as a TurboTenant user, totally free to do so. Also, we have a premium plan. I did include a link here to our forum. This is something we launched pretty recently. We have a community forum, so I made a post for this webinar. So it's about 1031 exchanges. I'll post the recording in there. It will also be emailed to all of you tomorrow, so keep an eye on your inbox. But if you have questions, even after this webinar wraps up, I'm sure Scott's still going to get to all the ones you guys are dropping in right now. But if you still have questions, please head over to that forum discussion, drop them in there, and let's keep it going. Because 1031 exchanges are extremely powerful, as I think Scott did a good job showing with his personal history.
Thanks, Jonathan. Hey, the question from Brad. Costs vary for qualified intermediaries, somewhere right around 1,000, maybe $1,500. Every company's got a little different fee schedule. Some, have one flat fee, sell one, buy one, and then each additional property you buy costs more. Our fee is $1,250. You can sell one and buy up to 3 replacement properties. So we make it really easy for somebody to scale and they don't get nickel and dime. Just one flat fee, sell one. You can buy 3, you can buy 2, you can buy one. It's all covered. So and by the way, I want to thank you guys. A lot of great questions. Hopefully, I was able to answer them sufficiently. It's so much more fun for me as a speaker, and hopefully for you, you get all yours asked. We've got a few minutes here. Fire away with any questions. I don't want you to walk away and not get a burning question answered. Do you need a QI in your residence state? No, Brad. You can do them anywhere in the country. Great question there. The main thing you want to look for, Brad, security of funds. I can't overemphasize that. There have been some huge bankruptcies over the years. The security of funds is paramount, and that's why having a subsidiary of a major company like a bank, title insurance company is just got many, many benefits. So I would recommend you go with somebody who has deep pockets and a big parent company backing him. That's probably the number one thing you want to look for. Yeah, great question. All right, keep firing away if you got other questions there.
Yeah, I just launched our ending poll here, but if you guys have any more questions, keep them coming.
Yeah, Luke, great question. I purchased a property for 90K, put 20,000 into it. So now your basis is essentially 110. You sell it for 150. So you have 40,000 of gain, just roughly. You would need to buy for the net sales price of 150. So if you sell for 150, you're going to have 8-9 grand in closing costs, so you're going to be buying for, I don't know, call it 142 or something like that. Again, all the net equity needs to be reinvested and you need the same or a greater amount of debt. That's really what you want to look at. Net equity after closing costs and then your mortgage payoff. As long as you reinvest all that cash and as long as you have the same or a greater amount of mortgage, you're golden. So if your purchase is less, then you just pay taxes on the difference. That's that taxable boot, cash boot or mortgage boot. So great question. Well, I want to respect everybody's time. I want to thank TurboTenant for doing this. They brought this to you because they want to give you information that makes you better real estate investors. They've got the software backing you up, and they want you to know tools that are out there. And frankly, I want everybody to take advantage of the exchange. If it makes sense for you, grow your portfolio. It is the path to wealth. Use the 1031 exchange to grow your portfolio, build wealth, pass on generational wealth, and do that. That's what you really want to do. And by the way, there'll be recordings. Everything's available recording. Okay, Luke. And Luke, thanks. You got a lot of questions. I want to buy 5 properties from another investor. Can I use the 150-ish of my property to cover the down payments? Absolutely, Luke. You're good. Again, number one, you reinvest in that equity. 2, same or greater debt. Then you've got 100% deferral. So I want to thank everybody. And Jonathan, I want to thank you and TurboTenant for hosting this and putting it on. Hopefully it was a great value add and gave some good information to everybody here.
Yeah, this was excellent. Thank you so much, Scott, for coming in and being our 1031 exchange expert. We will be sending out an email with the recording, with this chat, with the slide deck. You'll get it all. So keep an eye on your inbox. Should be tomorrow that we will send that. So thank you all, and we'll see you next time.